Hello, Oracles. Great news. Yesterday, SCHD announced that they are doing a 3-for-1 split. Now, this is just the Schwab Dividend Equity Fund, but it is the fund and ETF that is doing a split. So it's not just companies or individual stocks that go out there and do stock splits. There's also ETFs that do this. Now, as we'll discuss later, there's also some that do reverse splits, which in both scenarios, typically a split is something good that you want to see and bullish for the company or ETF, and a reverse split is bearish, not so good for the company or ETF. And I'll give you an example of that one in a little while. But SCHD doing a 3-for-1 split is great news. I'll break down some of that and some of the expectations that we can see about the split, what it means for the ETF going forward. And if this is some content that you guys like to see, please don't forget to hit that like button down below, subscribe to the channel, helps the algorithm know to put this stuff in front of you guys and in front of more people's faces as well. So looking at the SCHD split, now Schwab ended up going through and splitting pretty much all of their ETFs in this fund. There's SCHG and a whole bunch of other ones as well. I'm not invested in any of those. I'm just invested in SCHD. But if you guys are invested in any of the other ones, please let me know down below. So the 3-for-1 split is going to take place on October 10th, and on October 11th, it will start trading at the split prices. So right now it's trading just under $84. So that split's going to put it right between that $27 and $28 mark. So what can we expect from this? So the expectations that we're going to have for this are going to be slightly different than what we would see from a company itself. Now, again, it's still going to be very bullish because that means that this ETF is going to be opened up to be more accessible to people around the world who don't have access to fractional trading. But we're not going to see the same, run up into the split like we would for a normal company, like when Nvidia split, Apple split, Tesla split. A lot of times you see a run up into that split, a lot of euphoria behind it. I don't think we're going to get the same from the SCHD split. Just not the same feel. And with that said, we're most likely not going to get that post-split sell-off that we typically see as well from that euphoric run-up going into the split. So we won't end up seeing that, but what we're going to end up seeing is, again, that opportunity for more people to be able to buy in from around the world who can't access fractional trading. Another thing that you see from companies is going to be the fact that a lot of times they do the split because they want to make it more accessible to the employees and the employee stock purchase plan to bring that price down so that more employees can take advantage of that. SCHD does not have that, so it's not like by bringing the price down, all of a sudden a lot more employees are going to buy in as well. So slightly different strategies that are going to go behind this. And again, you're not going to see any massive movements from this, I don't think. But I think in the long term, it's going to be very bullish for the ETF. It opens up more shares to the entire world, opens up more shares to be purchased, and thereby, because of the fact that more people can have access to this, you're going to see that. Now, one thing that you can also take advantage of is the options that are played off of this. Because SCHD doesn't really move a lot, there's a lot of people who play options on the SPY, on VU, just because of the fact that it's a very slow mover and they can make some good money on these options as pretty almost easy money. So when you drop that price of SCHD down to that $27, $28 range, more people will have the ability to play options on this. For those of you who don't know, any options contracts are 100 shares. So right now, in order to play options on SCHD, you'd need to have about $8,300 to $8,400. You drop that price down with a split, you now need $2,700 to $2,800, much more accessible to some people who want to play options on this. So again, that there could make it a little bit more volatile from the options standpoint, but again, also a lot more accessible to people who just want to buy in long-term because SCHD is typically more of a long-term hold kind of play. Now, speaking of SCHD, this Sunday I'm going to be putting out part 1 of 3 of all of my favorite stocks and ETFs, and SCHD is one of my favorite ETFs. So that will be the part that I put out on Sunday, is about all of the ETFs. The reason I'm going to be doing it that way is because, especially for somebody who's a beginner getting into these things, an ETF is going to be a much safer way to go. It's a big blanket of a whole lot of different stocks that are out there. You don't have to learn to read the financial statements for all these companies. You can still be invested in the market. And then as you learn about all of those companies and how to read financial statements, then you can switch on over to individual companies. So I can't give any financial advice or real recommendations, but I can say if you want to get invested, ETFs are going to be the safest way to go to at least dip your toes into the water. So on Sunday, I'm going to break down for you guys my top 5 ETFs. And again, SCHD is one of those. It's number 2 on my list of all of my favorite ETFs that I've got. So huge fan of this split coming up for that 3-to-1. You guys can let me know in the comments below if you guys own an SCHD or again, if you own any of those Schwab ETFs. Now, the other thing I wanted to mention is about that reverse split and how that's not good. Now, Tesla is one that did a reverse split earlier this year. I sold out of Tesla shortly after that, did the reverse split. And reverse split is just when you see the NAV erosion. So NAV erosion is when you have an ETF and you see the price continually going down. Sure, that yield may still look good around that 50 to 60%, but the actual payouts that you're getting are coming down because that 50 to 60% is based on an eroding stock or share price. So if you get a share price that keeps on going down, it's like, hey, it was $100 and I got 50% off of that. I got $50. Great. You now drop that down to $50 per share and you get a 50% yield. Hey, you're still getting 50% yield. Awesome, but it's only $25 that you're getting. You're actually losing money over time. And if you're not going to be recouping any of that money and returning that share price going back up, you're losing over time. So for me, I ended up selling out of that. Now, some people play options off of Tesla because Tesla is an options type of ETF itself, playing synthetic option calls. So playing options on that, and a lot of people have been playing puts on it because with NAV erosion, you play puts, almost guaranteed money. So you can play it that way, or if it's going to rebound, where Tesla stock itself has rebounded, Tesla itself will rebound a little bit. It does not rebound the same way, but if you can kind of time it, great. And you want to buy it at the bottom and maybe run it for a month or two to get some nicer income off of this as it actually is going up over maybe a month or two, that's great. But again, that is now you trying to time the market and hoping that you're going to be able to catch this at just the right time for that run. That's not a game I want to play. I have switched away from playing that game. Nothing I want to do. If you've got the risk tolerance for it and you want to try to play that, go for it. Just not my thing. And again, seeing a reverse split on that is just telling me that it's going to continue to come down. The company who's running it doesn't mind doing the reverse split on this, and they'll just keep on reverse splitting, reverse splitting, reverse splitting. And eventually your money is just going to keep on dwindling down. So again, do your own due diligence research on that one, but I ended up getting out of that myself. Now, when it comes to those YieldMax ETF, there is some other good news that came out from them. YMAG and YMax both went to weekly payouts. Now, I do own YMax. The reason I like that one is it does have NAV erosion to it, but they don't pay out as high of a yield, which means that it kind of stays a little bit more steady and it's at least more stable income coming in without the NAV erosion depleting as fast as a Tesla. So I've got that one. And again, it's a smaller portion of my portfolio. I don't plan on keeping it for a long time. It's strictly to kind of speed up the process of getting that income coming in to put into all of my other plays that I want to have to build up the stronger foundation of my portfolio. But going to a weekly payment on these means that I will have cash coming to me a lot more frequently to be able to take advantage of any dips or opportunities in the market. And because of what we have going on over the next 6 weeks with the election, I think we may see a bunch of great opportunities in the market itself to be able to take advantage of that. So getting those weekly payments is great because now I have more money coming in more frequently to be able to do all of that and take advantage of it. I put $50 every single week into my portfolio as it is right now. So I'll be getting probably like $10 to $15 every single week from YMax to be able to do that as well. Nice little bump right there. So I'm pretty excited about that. Don't know what I'm going to be doing about keeping it in the long term. But again, as soon as I get myself to a point where I really don't need that income coming in from those, I'll end up dumping that. Now, another play that switched over to a weekly payout is JEPY. JEPY ended up switching over and they actually changed their entire ticker symbol to WDTE. Now, they also did a reverse split. So I'm really kind of monitoring them personally, them and QQQY. So they did reverse splits, but they did it in a manner where they bumped the stock price up significantly higher and the payout stayed about the same. So the pay versus the yield stayed about the same. So again, I'm keeping an eye on those and I'm doing the same thing with those as I do with YMax, which is just monitoring them and I'm just taking in the income and spending it elsewhere. I'm not dripping that money from the ETF back into it. I'm using it for other plays. And I've already made a good chunk of money on these two. So I'm really not as concerned about the NAV erosion on them. But JEPY switching over to WDTE, now also paying out weekly, now means that between YMax and WDTE, I will be having 2 weekly payments coming in from ETFs. Again, more cash flow coming in for me to invest into my other plays. The more frequent the cash flow you have coming in, the more that compounding interest is going to help you out. And again, if I was putting it back into those with the NAV erosion, may not be a positive thing. But because I'm taking that cash and I'm putting it into other plays that do have positive equity growth and dividend growth, that is where you're going to make the big difference. So for me, it makes a lot of sense to keep these for right now and just keep on pumping that money into my other plays. You guys can let me know in the comments below. Do you own either of those? WDTE, formerly known as JEPY, or YMAX? Maybe you own YMAG. How do you guys feel about those YieldMax ETFs or those extreme high income ETFs like a JEPY, WDTE, or a QQQY? Let me know your thoughts in the comments on those. Again, I only have 4 of them. I have CONY also. Those are ones that are not in my top 5 favorites, so I'm not going to be sharing those, but I do own those 4. And again, any of you guys who are members or patrons, I will be sharing that spreadsheet. That's another goal I have this weekend, is to be able to get out to you guys a live spreadsheet of what I'm doing so you can see all of the moves that I make constantly, every moment of every single day. Whenever you want, you'll see all of those live moves. So I'll get that out to you guys this weekend. All I'm going to need from you guys is your emails, but I'll make a post about all of that this weekend as well to be able to gather those from you so that I can make sure that you have access to all of my spreadsheets. And one of the other things I'm going to go over in the future as well is the difference between dividend growth and dividend yield. And there's a lot of people who go out there and chase yield. Some people who are out there for just income investing alone are going to go out there and just look at the yield itself, and they're going to try to bring that money in. And again, it's not terrible, but if you've got NAV erosion, you want to stay away from those altogether. There are some people who don't care about any appreciation. They don't care if the stock or equity price stays stable. That's perfectly fine to them as long as they consistently get those monthly payments or quarterly payments or whatever they are to have consistent income coming in. It's a totally different strategy when it comes to dividend investing, and Armchair Income does do a great job on that if you want to follow his channel. And for me, I'm kind of doing a hybrid of a lot of different things. I'm getting high yield income coming into myself to be able to have that cash flow coming in to invest in other plays. I do have some stable income plays that are higher yield between that 8 and 12% that don't really show a lot of appreciation when it comes to the stock or ETF price, but they're going to be giving me consistent payouts. I don't drip any of that money either. I use all of that money to then go and buy those longer term dividend growth ETFs and stocks. That's where I want the bread and butter for the long-term foundation of my portfolio. I'm just utilizing the other 2 to be able to funnel that cash in to then put it into those other places. And I'll discuss a lot more of that on Sunday when I give you guys part 1 of all of my favorite ETFs and stocks. But again, dividend yield and dividend growth are totally different. And the easiest way I can break it down for you is dividend yield is the pay you make at your job right now. Dividend growth is the raise you're going to be getting at the end of the year or your annual raise or whatever it is. So if you have just a dividend yield and you're only focusing on your pay right now, but you're not getting any dividend growth out of it, that would be like working at your job and never getting a raise. You don't want that. If you had a job that you never got a raise at, that was me for the last 3 years, it's pretty frustrating, especially when inflation is going through the roof. If your raise is not higher than inflation, you're actually losing money, which is what ended up happening to me over the last 3 years and what kind of got me into this dividend investing as it is. And I'll show you guys with my spreadsheet later that my dividend income has been growing. My dividend growth is significantly higher than what any raise I have ever gotten in my entire life. So looking at year over year income raise from dividends just really excites me because no way I would ever get that at a job unless I got a promotion. And I'm not at a point in my career where I'm going to be getting any more promotions. So for me, I'm going to rely on myself and my investing to increase my income. And that is where the dividend growth comes from. So again, if you guys are out there, you're newer to dividend investing and you're looking at it, just remember, dividend yield is like the income you make from your job. Dividend growth is like your raises. If your stock or ETF are providing a great yield, but no dividend growth, do you really want to stay in that? So again, if it's paying you very well, maybe you do. Maybe it's one of those 8 to 12% income pairs that, stays steady and you're just going to continue to keep on making that money. But again, when you look at a chart in the long term, you're eventually just going to end up falling below the curve when it comes to inflation. So just pay attention to that. Make sure you're doing your due diligence and research on all of that. Last thing is I am going to be doing financial coaching soon. So I'm going to let you guys know what's going on with that. I'm going to break off a block of time. So if you guys, especially as members and patrons, I'm going to put that in there as part of the perks for you guys is to get some free financial coaching from me. I'm going to be doing free consultations and then paid blocks of time as well in the future. If it's something that you guys want to continue with going forward, I'll give you guys all access to the spreadsheets for you to be able to use yourself to track your budget, track your investments, track your own personal P&L, your profit and loss statement, to budget out for yourself, because it's extremely important to make sure you do a budget for yourself. Budgeting is going to be the number one way you're going to be able to get yourself to a better financial position. So having a plan set, budgeting, and that's something that I'm going to be able to provide for you guys and help coach you through all of that. So once I'm ready to do all of that, I'll let you guys know in the future. Otherwise, that's all I've got for you guys today. Thank you so much for watching. I appreciate all the support. Have a great one.